Hi, this is Joe Rabil with Invest Like a Pro. Want to spend some time talking a little bit more about the two time frame pinch play. I outline this in my book. I have an entire trading plan in the book. It goes into a lot of detail as to how many to do at a time and how much to risk per trade, and how many to do per sector and all. But I wanted to spend more time on the actual signal and setup. And the main reason why I like this as a trading plan is because if someone is new to trying to trade in multiple time frames, this gives a really good way of learning and getting more proficient at it. There's a few things about the setup and the two time frame pinch plan that actually I think is pretty important. First of all, it's going to use two time frames. The higher time frame is your tradable time frame, and it's going to find the trend. It's going to tell you what the direction of the trend is by following the rules. And secondly, it's going to make sure that that time frame isn't too overbought, because there are a lot of times when a market might be, or a stock might be looking strong or in a good trend to the upside, but it's not really timely because it's already made a pretty big move. So by default, the rules of this approach sort of eliminate that kind of risk. So I really like that aspect to it. And then it also helps you understand how to wait for the trigger on the lower time frame. So let's get right to it right now. I'm starting here with a monthly chart of Chevron. I really want to make this point again. I use monthly, weekly, daily a lot of times. I could go show you a 60-minute. I could show you this pattern on a 10-minute and a 2-minute right now. But I'm using, I like to mix up my time frames, and I like to use the monthly, weekly, because I think, number one, the trends are very smooth. And secondly, I think it gives you a really good idea how you could put some money to work and not have to agonize over it on a day-to-day basis. You could put this trend on, you could put your stop in place, you can put your targets in place, and you really don't have to sit there and watch every tick. So getting back to Chevron, I'm just going to, I want to point out this spot. I'm going to just highlight this area right here. This is the zone that I want to focus in on. And just to make things a little clearer, I'm actually going to add in an indicator. This is my zigzag again. And what I'm trying to point out here is the trend was down through this period in 2015. You went down, 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 right? And if I were going to go and draw my trend line in place, here's the low. I'm going back to the prior high, the prior peak, and that's my anchor point. So I draw the trend line in, say this way. And I have a break of the trend line. I actually, broke it here and then tested the low and then turned up. And when you took out this peak, the trend is now up again. And then it actually made another peak here and then another low. So you're clearly in an uptrend. By the time you reach this colored area, this shaded area that I've created, and you pull back from it, clearly the monthly trend is positive. I'm going to just pull this over and let's look at the weekly chart during this time frame. Let me just spread this out a little bit, zoom in a little bit so you can see it a little clearer. So the point I'm making is you broke the downtrend on the monthly, you've turned up, and the trend is now to the upside. And this is truly your first pullback to the 18, which is now rising, the 18 on the monthly chart. And I think this is a really good area. If I want to do this on a weekly chart, this area is a great spot. Pullbacks to the 18 week, pullbacks to the daily 18 day. But I like to look for new trends that are pulling back to this 18 MA area. And then I'm going to go and look at I'm going to describe the pinch, which is the MACD line is the red line. The blue line is the signal line, which is a moving average of the red line. And when the blue line turns up, I know the trend is to the upside. What the red line is doing is it's a little more sensitive because it's following the movement of the price action a little bit more closely based on the closes. And when the red line starts to hesitate or pull in a little bit, counter to the blue line, I know that I'm getting a pullback in an uptrend. So if the red line pulls back or pauses while the blue line is rising, I know that I've got a pullback into an uptrend. So it gives me a little bit of an advantage knowing the blue line is giving me a little bit of a confirmation as to what I'm seeing on the higher time frame trend, because I know I've broken the trend line. I've got my 1, 2, 3 change in trend to the upside, and now I'm getting my pullback. The pullback is being confirmed by this slight little pinch here. So I've got this area blocked off. And I just want to point, so I'm going to take this box off in a second. I'm going to take off the zigzag as well. But I do want to point out, if you notice on the higher time frame, this is just this whole move from here down to here is just a simple pullback, meaning you go from a high, there's no lower high along the way. It just goes straight down to the bottom and then starts to turn. Now, there is one little hesitation point here, but it's really not a factor in this situation because you don't have a trend to the downside. It's still trending to the upside. So I think that's a really key point I just want to make. So let's go and look at the weekly. And I'm going to zoom in a little bit. Notice what happens on this simple pullback on a monthly chart, which is just the line is just a straight line going down. Through that whole period, you made a low, and then you made a lower high, and then you make a lower low, and then you made a lower high, and then to make another lower low. This is a trend. So on a weekly chart, you're in a downtrend through this period, but on the monthly, you're still in an uptrend. This is key criteria. I think you need to understand what you're seeing if you're going to trade in two different time frames. The rules for the 2 time frame pinch say I'm looking for 2 lower highs on the higher time frame, and I want to see some type of a hesitation in the red line while this is staying above the blue line. But the key criteria is making sure I've got 2 lower highs. Well, I've got that in place. The second thing I'm going to do is I'm going to go down to the lower time frame, and I'm going to wait for the next time that actually happens on this time frame, which is where the red line crosses above the blue line, which is meaning MACD is crossing above its signal line, and then I get the pullback, a 2 lower high pullback. That's actually taking place right here. I wanted to keep this box on for just a second, and the point I wanted to make, I'm going to delete it now, is through this period, as you're pulling back, you kind of want to know what is taking place. So if that's the low point, that's the low. I'm going to go back to the prior bar. That's my anchor point for my trend line. I'm going to draw in a trend line here. And I know that I'm breaking the trend line. I've moved up and I'm pulling back to test the low. And then when I take out this high, that's my 1, 2, 3 change in trend. So I broke the trend line, that's 1. I came back and tested the low, that is 2. And when I took out this peak, that's 3. So after this rallies up and pulls back and I get this is my 2 lower highs and my second pinch right here, this pinch play is now confirming that I'm starting a new uptrend because I've already done my 1, 2, 3 change in trend on this time frame. This is my first low risk pullback and entry on the lower time frame. So just by following the rules of a 2 time frame pinch, I am following the criteria of change in trend on the higher time frame and buy a pullback, and then lower time frame change in trend and buy a pullback. So I think what I really love about this 2 time frame approach and using the pinch is that it really helps you identify the key buy areas. Again, if you want to trade in multiple time frames. So this is sort of the key. I don't want to go in too much more detail. Your target areas for this type of trade, they can be at this level. If you really like what you're seeing on the bigger time frame, you could go up into the higher levels up here as your risk reward, or you could take a partial profit here and look for a bigger profit on another half up here. There's a lot of ways to manage the position. I know I say 3-to-1 in the book, but there's a lot of opportunity to change that. You could go for 2-to-1 or 3-to-1, however you'd want to do it. If you did 2-to-1 here, you would take a full profit at this prior high, And then if you notice, another pinch play develops and you would have gotten long and you would have made another 2-to-1 going up into this peak. So I don't want to get too hard and fast with the rules on the targets. All this is outlined in my book, and I give a lot of detail in there and a lot of examples. But I thought I'd just make sure that I want you to understand the importance of why I think this strategy and using this strategy as a training tool can be really helpful. Hit the like button and subscribe if you want to see more videos like this. Thank you.